Hello fellow compounders, welcome back. Are you looking for the best way to invest $10,000 for big dividend growth? In today's video, we're diving into the exciting world of dividend growth investing. We'll review the best way to invest $10,000 or any amount for that matter in dividend growth investments. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor and you are responsible for your own financial decisions. Dividend growth investing is all about finding companies that consistently increase their dividend payments. This means that you'll benefit from growing dividends and potential stock price appreciation. But how do you invest $10,000 effectively to maximize dividend growth? Time for a showdown. Active versus passive investing. Which is the ultimate way to build a dividend growth portfolio? Active investing involves researching and selecting individual stocks, while passive investing focuses on investing in mutual funds or ETFs that track a specific index. Both strategies have their pros and cons, so it is essential to find the right balance for your investment goals and risk tolerance. If you're all about that active investing life, follow these steps to build a dividend growth portfolio. Number 1, research and select individual stocks with a history of increasing dividends, strong financials, and a competitive advantage in their industry. Look for high dividend yields, but also consider dividend growth rate, payout ratio, and earning stability. 2, diversify your portfolio by selecting stocks from various sectors and industries to reduce risk. 3, regularly monitor your investments to adjust your portfolio as needed to maintain the desired level of diversification and risk. Remember, active investing requires more time and effort, but it does offer potential for higher returns if you're skilled at picking stocks. But one side note, just remember that if you don't have that much money, like in our case, we're starting out with $10,000, I suggest going the passive way. Do you prefer a more laid-back approach? Here's how to build a passive dividend growth portfolio. Number 1, invest in a low-cost index funds or ETFs that track a dividend growth index, such as the Vanguard Dividend Appreciation ETF, symbol VIG, or the Schwab US Dividend Equity ETF, symbol SCHD. Number 2, consider investing in ETFs that focus on dividend aristocrats. These are companies that have consistently increased their dividends for at least 25 consecutive years. Examples include the ProShares S&P 500 Dividend Aristocrat ETF, ticker NOBL, and the SPDR S&P Dividend ETF, symbol SDY. And 3, diversify your portfolio further by investing in international dividend-focused ETFs like the iShares International Select Dividend ETF, symbol IDB, or Schwab's International Dividend Equity ETF, symbol SCHY. Passive investing is more cost-effective and requires less ongoing management, but it may limit your ability to outperform the market. Can't decide between active and passive investing? Try a core and satellite strategy, what we call a hybrid approach. This approach combines passive ETFs for broad market exposure and stability with individual stock picks for potential outperformance. By striking the right balance between passive and active investments, you can create a diversified portfolio focused on growing your dividend income over time. To pick the best dividend growth stocks, you need to know your metrics. These are indicators that will help you identify companies that are likely to provide growing dividends and solid returns. These metrics are: number 1, the dividend yield. The dividend yield is the annual dividend payment divided by the stock's current price. This percentage indicates the return you'll receive from the dividends alone. While a high dividend yield can be attractive, make sure that it's sustainable in the long run. Number 2, dividend growth rate. The dividend growth rate measures how quickly the company's dividend payment has grown over a specific period, such as the last 5 years. A higher growth rate suggests that the company has been consistently increasing its dividends, which could be a positive sign for long-term investors. Number 3, payout ratio. The payout ratio is the percentage of earnings paid out as dividends. A lower payout ratio indicates that the company retains more of its earnings for future growth or to increase dividends in the future. On the other hand, a higher payout ratio may suggest limited room for dividend growth or potential vulnerability during economic downturns. 4, dividend aristocrats. As mentioned earlier, dividend aristocrats are companies that have consistently increased their dividends for at least 25 consecutive years. This demonstrates a commitment to returning value to shareholders and a strong financial position. Number 5, earnings growth. Companies with consistent earnings growth are more likely to increase their dividend payments over time. Look for companies with a history of steady earnings growth, as this can provide a solid foundation for future dividend increases. 6, debt to equity ratio. The debt to equity ratio compares a company's total debt to its total shareholder equity. A lower ratio indicates that the company has a lower debt burden, which can be a positive sign for dividend growth investors. High debt levels can limit the company's ability to increase dividends, as the company may need to prioritize debt repayment. 7, free cash flow. Free cash flow is the cash generated by a company operations that is available for distribution to its investors. Companies with a strong and growing free cash flow are more likely to have financial resources to increase dividend payments. By considering these metrics, you can identify companies with strong dividend growth potential and make informed decisions when building your dividend growth portfolio. Don't forget about taxes. Dividends can be taxed differently depending on your location and the type of dividend. In the United States, qualified dividends are taxed at a lower rate than non-qualified dividends. To minimize your tax liability, consider holding your dividend-paying instruments in tax-advantaged accounts like a 401k or an individual retirement account IRA. To make the most of your $10,000 investment, use a broker that offers fractional trading. This allows you to buy partial shares of stocks and ETFs, enabling greater diversification, accessibility to high-priced stocks, efficient allocation, and automatic dividend reinvestment. Brokers like Robinhood, Fidelity, and Charles Schwab offer this feature. Ready to dive into dividend growth investing? Keep these tips in mind. Number 1, be patient. Dividend growth investing is a long-term strategy. Give your investments time to grow and compound. Number 2, reinvest your dividends. Maximize your growth potential by reinvesting your dividends through a dividend reinvestment plan or DRIP, or by using the income to purchase additional shares. Number 3, stay informed. Keep up to date with the financial performance of the companies in your portfolio and market trends. 4, consult a professional. If you're unsure about your investment decisions or need help crafting a personalized strategy, consult a financial advisor. Now, let's take a look at a real-life example at a core and satellite dividend growth portfolio using a 70% passive and 30% active allocation. The core, 70%, which is $7,000 of your $10,000 portfolio, will have, number 1, a 40% allocation of Vanguard's Dividend Appreciation ETF, symbol BIG, with $4,000. Number 2, ProShares S&P 500 Dividend Aristocrats ETF, symbol NOBL, Noble, with a 20% allocation or $2,000. And 3, iShares International Select Dividend ETF, symbol IDV, with a 10% allocation or $1,000. And the satellites for 30% or $3,000 are, number 1, the 3M Company, symbol MMM, with a $1,000 allocation or 10% of your portfolio. Number 2, AVI, symbol AVVV, with a 10% allocation or $1,000. Number 3, Cisco Systems, ticker CSCO, with a 10% allocation or $1,000. This example provides a diversified mix of passive ETFs and individual stock picks aiming to capture both stability and growth potential. As always, do your own research before investing. There you have it. Investing $10,000 for big dividend growth can be achieved through a combination of active and passive strategies tailored to your goals, risk tolerance, and investment horizons. Be patient, reinvest your dividends, stay informed, and don't hesitate to consult a professional. And of course, watch our channel. Thank you for watching. Remember to always be compounding. See you in the next video.